Hi everybody, and welcome back to video number 5 in chapter 13. And when we left off, we were looking at an illustration of an interest-bearing note. Here, the Marie Company issues for cash $10,000, 3-year note bearing interest at 10% to Morgan Corporation. This is the same note that we presented in chapter 6. The market rate of interest for a note of similar risk in this case was 12%. So this is going to be selling at a discount. So what is the time frame? Here you can see in small print, we're going to be paying $1,000 per year in interest. That's what's written on the note. That'd be 10% of a $10,000. But the prevailing rate is 12%. So we go into the present value tables. We take the present value of the principal from table 5.2 based on 12% for 3 periods, and that comes out $7,118. We do the same thing for the present value of an annuity of $1,000 for 3 periods, and we get $2,402. That totals $9,520, leaving us a discount of $480. So we receive that cash, we debit cash, $9,520, and we'll also debit discount on notes payable for $480, and we'll credit the full face amount as notes payable for $10,000. So now, if we refer back to that, what would be alpha? What would be the 3-year amortization schedule using the effective interest method? And bravo, what is the entry to record the interest expense for the first year of the note? Going back to our trusty Excel spreadsheet here, we start with the carrying value of the note. We multiply that times the effective rate, which in this case was 12%, and that comes out $1,142. Interest paid would be the face value, 10,000 times 10%, which is written on the bond or the note, and that comes out $1,000. So we would have a discount to be amortized here, just like we did with the bonds. Not hard. Again, the carrying value will ratchet up to the face value over the 3-year maturity. Now under Bravo, we're going to record the first year's interest payment. So we'll debit interest expense here for a little more than $1,000 because the note was sold at a discount, and we'll credit the full cash here for what we pay for it, and that difference is $142, which we could get from the Excel spreadsheet as well. Okay, now at the end of year 1, that note payable is going to be reported on the balance sheet at its carrying value of $9,662, which you see here. Okay, now special note payable situations. When the notes are issued for property, goods, or services, when exchanging the debt instrument for property, goods, or services in a bargained transaction, the stated interest rate is presumed to be fair unless one of these 3 conditions exists. Number 1, no interest rate is stated. Number 2, the stated interest rate is unreasonable. Or number 3, the face amount is materially different from the current cash price for the same or similar items, or from the current fair value of the debt instrument. Let's take a look. Here, the Scenic Development Company sells land having a cash sale price of $200,000 to Health Spa Incorporated. In exchange for land, Health Spa gives a 5-year, $293,866 zero interest bearing note. The $200,000 cash sale price represents the present value of $293,866 note, discounted at 8% for 5 years. Should both parties record the transaction on the sale date at the face amount of the note, which is $293,866, we'll explain why not. And then under Bravo here, what entries do Health Spa and Scenic Development make at the exchange date? So for the solution under Alpha, no, they're not going to record the same amount. If they did, Health Spa's land account and Scenic sales would be overstated by $93,866, and that's the interest for 5 years at an effective rate of 8%. Similarly, the interest revenue to Scenic and the interest expense to Health Spa for the 5-year period would be understated by that same amount. Okay, under Bravo, here is Health Spa's entry. They're going to debit land for $200,000. They'll debit the discount on the notes payable for $93,866 and credit notes payable for $293,866. Health Spa is the buyer in this case. Scenic Development Company is the seller. They're going to show a $293,866 notes receivable as a debit, and they'll credit the discount on notes receivable for $93,866. Their sales revenue will be the $200,000 price of that land. Okay, a little complicated there, but I think you see the effects. Choice of interest rate. In rare situations, if the company cannot determine the fair value of the property, goods, services, or other rights, and if the note has no ready market, the company must approximate an applicable interest rate. That choice of interest rate is affected by bullet point 1, prevailing rates for similar instruments. Bullet point 2, factors such as restrictive covenants, collateral, payment schedule, or the existing prime interest rates. Let's take a look at an example of an imputed value of a note. On December 31, the Wunderlich Company issues a promissory note to Brown Interiors Company for architectural services related to its building. The note has a face value of $550,000, a due date of December 31, 2030, 5 years later, and it bears a stated interest rate of 2% payable at the end of each year. So, interest paid each period is therefore $11,000. That's 2% of $550,000. Wunderlich cannot readily determine the fair value of the architectural services, nor is the note readily marketable. On the basis of Wunderlich's credit rating, the absence of collateral, the prime interest rate at that date, and the prevailing interest on Wunderlich's other outstanding debt, the company imputes an 8% interest rate in this situation. What is the present value of the note and the imputed fair values of the services received by Wunderlich? Well, let's look at the time diagram. Here's the $11,000 cash interest payments, and the $550,000 principal. So the face value of the note was $550,000. The present value, again, will go into the table 2 for the present value of an amount at 8% for 5 years, and that factor times 550,000 is $374,319. Then we take the present value of an annuity, again, 8%, 5 periods. We take that factor and multiply it times $11,000, and that gives us $43,920. We add those two together, and that gives me the present value of the note. That means that the discount on the notes payable, the difference between $418,239 and $550,000, is $131,761. So now we're going to take a look at that same example. What is the entry to record the issuance of the note? What is the amortization schedule for the note? And the entry required for the note in 2026. Okay, so Wunderlich is going to record buildings at $418,239, the discount which we just calculated at $131,761, and notes payable of $550,000 credit. Under Bravo, the 5-year amortization schedule, as usual, we start out with our carrying value of $418,239 and ripple that through the schedule. The cash we paid based on what's written on the note, but the interest expense substantially more than the cash paid here is going to be the carrying value times the effective interest rate of 8% in this case. Okay, so that would mean that we're going to record the first, or the December interest expense at $33,459 as a debit. We'll credit the discount on notes payable here at $22,459, and we'll credit cash for $11,000. So on Wunderlich's balance sheet, the note payable would be listed at its carrying value, shown in red here, at $440,698. All right, a promissory note secured by a document called a mortgage that pledges title to property as security for a loan. Most common form of long-term notes payable. Normally, it's going to be paid in installments and payable in full at maturity. Sometimes it's a fixed rate mortgage, sometimes it's a variable rate mortgage. So an illustration of an installment note would be on December 31, 2025, Morning Brew purchases a new building for its corporate headquarters, borrowing $102,049 and agreeing to pay $40,000 down, the present value, and then paying that balance of $80,000 by making 4 equal installments of $20,000 each on December 31. After considering the mortgage points on the borrowing, an interest rate of 11% is imputed. So the question, what are the journal entries? Alpha, on the date the note is issued. Bravo, for the note on December 31, 2026, and December 31, 2029. And we're going to assume the effective interest method is used for amortization purposes. This looks like a good place for us to end this video. And when we return, we'll take a look at how we would do those journal entries. Until that time, bye for now.